Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Ira Harris and Peter Boockvar. Ira is a hedge fund manager, global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He was also CME director from 1997 to 2003. And Peter is chief investment officer for the Bleakley Financial Group and Advisory. He has a newsletter product called Book Report, BOOCKREPORT.com, which has great macroeconomic insight and perspective with lots of updates on economic indicators. Welcome, gentlemen.
Hey, Rich. Hi, Ira.
Hi, Rich.
Okay, I thought today would focus on a number of aspects for the global economy and financial markets, central bank policy. You recently made some observations that the Federal Reserve could be hiking the U.S. into a recession. Can you elaborate on that, on your thoughts?
Well, it's what they typically do. Most rate hiking cycles end that way, and not sure why this would be any different. We have to understand that not only are they raising rates, but they're also letting their balance sheet roll down. So there is a double tightening going on that only recently have markets begun to appreciate.
And how do you see that playing out currently in the financial markets globally with all the volatility?
Well, from a market perspective, we've already seen a bunch of different potholes this year, I think driven by the rise in rates. So the 10-year yield at the beginning of the year went from 240 to 270, and you blew up the short VIX trade. Then Turkey was exposed for the debts and deficits and rising inflation that they have, which really was no mystery. They've had also political issues for years, but in a rising rate environment, vulnerabilities get exposed. And it started in Turkey, then went into Argentina, and of course you had a blow up in the Italian bond market, just as the ECB is wrapping up their own QE program. From an economic standpoint, the rise in rates is already slowing down the pace of transactions in the housing market and in the auto sector. And also we have to pay now even closer attention to corporate balance sheets, where a lot of the excess has been created in this cycle. You look at small cap stocks, particularly those in the Russell 2000, about 40% of debt on Russell 2000 balance sheets is floating rate, which is obviously now very susceptible to the rise in LIBOR. And the question is whether cash flows can then deal with that rising cost of capital. Also, from a leverage standpoint, small companies in the Russell 2000 have a debt-to-EBITDA ratio of twice those in the S&P 500. So this rise in rates, this rise in the cost of capital is beginning to have an economic impact. And as I mentioned before, certainly a market impact.
Do you see this as being bearish on credit-sensitive cyclical sectors?
Well, so far, because thrown into the mix is, of course, a slowdown in the global economy, particularly in China and in Europe. So a lot of industrials obviously are cyclical. They have high fixed costs and very sensitive to changes in economic activity. So a lot of confluence of events are combining for what is obviously a much different market this year compared to what investors are used to over the past couple of years.
And is this all creating a emerging market crisis as well as emerging crisis in the European bond market?
Well, I don't want to speak broadly. When you mention crisis, certainly in Turkey there has been one. Certainly in Argentina there has been one with short rates north of 60%. That's a crisis. We'll have to see how it plays out in China, but China has a long road to hoe in terms of the enormous amount of debt that they have, the weakening currency, the capital flows, the current account deficit, and so on. So a crisis, I don't want to say that just yet, but certainly this rise in rates, this drain in global liquidity creates a lot of potholes, as I said. And if you look at just the ECB, the Fed, and the BOJ this year, or this quarter, beginning October, on a monthly basis, there's a net zero liquidity injection if you add in the behavior of those three central banks. So that creates also a drain, and I think also is responsible for a lot of the fragility that we're seeing now in markets.
Will this all create strengthening of the U.S. dollar?
Well, it has against certain currencies. It has against the yuan, of course. It has against the Turkish lira and the Argentinian peso. But if you look at the Euro Heavy Dollar Index, the average level of the dollar index over the past 2 years is 95. And today we're a little bit over 95. So for all the talk about Fed rate hikes and how our central bank is far ahead of the curve relative to others and U.S. growth is so great compared to everybody else, the dollar index is basically in line with its average over the past 2 years. So it's been strong against certain currencies, and it's done nothing against others.
Mm-hmm. And what about in China? You've observed that off-balance sheet government liabilities in the regions of China has amounted to $6 trillion US. Do you see that as a gigantic credit risk?
Yeah, that on top of the amount of assets that's on their banking in their banking system relative to the GDP. So we're about to see how they handle this enormous debt load. Is it something that they can paper over? Is it something they can grow their way out of? Is it something that's going to be like Japan that's just going to linger for 30 years? We'll have to see, but there are some serious challenges in the short term. I mean, long term, I'm pretty bullish on China. I think that they're the economy of the 21st century, but I certainly don't discount and don't take for granted that in the next couple of years could be a tough road for them.
What do you make of the standoff between Italy and the European Union, Brussels? Ira, you've observed that Rome knows that the higher Italian yields are forced by the rhetoric of Brussels bureaucrats, the greater the losses for institutions forced to sell in any type of panic. You've observed in your blog. What do you make of that standoff?
Well, the standoff is real. Unfortunately, I think there's a lot of people who talk in Europe who really fail to understand, or they don't want to understand because it's not in their interest to understand, that the Italians, they understand perfectly what's going on here. And I think that, if I were to prognosticate, which is always a dangerous thing, as who told us that, Yogi Berra, it's always dangerous. They know what they have. And the problem for the Europeans, of course, and we saw it, in fact, I was going to blog about it tonight if I get a chance. There was a piece in the FT. It's a compounding problem for Europe. They have the Italians who understand what's going on here. They have the Brexit situation, and they have Trump that they have to worry about. And Trump, one thing we know about the president is he doesn't forget slight. We know that. Now, that doesn't mean that he actively pursues a vendetta, but he does not do well with slight. And at that G7 meeting, Merkel and Macron and a few others really slighted him. There's that famous picture, and it wasn't pretty. So there was an article in the FT last week titled "Donald Trump Looks to Start Formal U.S.-UK Trade Talks." Okay, so there's three things that work here. You have the Italians who understand the pressure because there's really nothing Brussels can do because of the whole QE program has tied them up. I know we've talked about this quite a bit over the years. That Draghi piling on all that debt. There's a lot of people who run the risk of debt. And the bigger problem, and I know Peter sent me a nice note about it the other day, in the zero risk weighting under the Basel rule, they're carrying all this Italian debt. All these banks carry this debt, including the ECB, and there's no risk to it according to the rules of Basel. So that provides a potential problem. Number two, you have Trump, who will throw a lifeline to the Brits. Unlike Obama, who made a categorical mistake, and I felt it and said it in real time, that to say, hey, you're going to the back of the queue, Donald Trump says to the UK, you're going to the front of the queue, and we may even create a free trade zone with you involved in it, which would be death for the Germans because of all that auto capacity, manufacturing capacity that was built by the Germans and the Japanese in Britain. So you have that. And this really locks up Europe. And they don't have any leverage. When I hear people talk about what leverage they have, what leverage? The Italians go, what are you going to do to me? So rates are going to go up. All right. We saw rates in Greece go up to 40%. And you know what? Greece is still here, and they're talking. So you're going to have to, come to some resolution. We need growth. We need growth. And I think there are actually more people in Europe who support the Italian position than we hear reported. So, I mean, we have these at bay, and I think that this plays really into Salvini and Di Maio's hands and gives them a lot of strength. I don't think that Brussels has any strength in this negotiation whatsoever.
Peter, your thoughts?
Well, it's interesting because one of the proposals from Salvini in this budget, proposed budget, which I haven't really read about, is lowering taxes and having a flat tax. That's growth encouraging and a huge growth incentive. The spending side, well, that's not really long lasting in terms of generating growth. So you get stuck with more debt, higher deficits, and you don't really get the growth. So I think that's what the concern is, the Keynesian side of this budget that I think is the concern, and the assumption that it's going to magically improve the long-term competitive and economic growth rate of Italy, which it won't. Only lowering taxes and the massive regulatory state will. Paying people universal income and getting rid of the extension of retirement age and pensions, that's not growth enhancing. So that's what I'm worried about, that they're not going to get the growth that they're hoping for. And bigger picture, I keep arguing that the behavior in the Italian bond market in response to what's gone on is just the canary, and that when now the European Central Bank is 2 months away from stepping away from its purchases, who's going to buy these bonds? I mean, they were really the only buyer. I mean, even Germany, which has a budget surplus and has a grade A fiscal situation, who's going to buy a German bond at 40 basis points when inflation is running at 2%, or PPI today, which printed 3.2% for September? Who's going to buy a French oat for less than 1%? Who's going to buy these things? And I think that's a big question, and I think that has broader implications for the entire region, and that Italy is really the poster boy initially because of the enormous amount of debt that they have and so little growth that they have, to the point where their financing costs are now running above the rate of nominal GDP growth, which means that their debt to GDP ratio begins to spiral upwards again.
So do you see Italy as changing their budget per the request by the EU Brussels?
I mean, I'm sure, and Ira has been saying this, I'm sure there's some agreement, because Italy is really carrying the leverage here. There's only so much that the EU can do. So, but I do think that everyone realizes it's in their best interest, and I think that at the end of the day, it'll be the EU that folds and gives into what Italy wants to do. I don't think what Italy is trying to accomplish is, as I mentioned, going to work, but I think the EU is going to have no choice but to at least give them a try. And the ultimate decision maker here of how this is going to go is going to be the market. If the market sees that Italy can't generate the 1.5% GDP growth that they've budgeted for next year, and it's going to be less than that, then the bond market's going to speak up, and you're going to see a much higher rise in interest rates, because even at a 3.5 or 3.6% 10-year yield relative to the fiscal situation in Italy, that's still historically a pretty low yield.
Ira, do you see that same rise in interest rates?
I think Peter is right about that, but I'm looking more in the short term, what the effects are going to be. So look, Europe needs an infrastructure program bad. Even the Germans seem to be admitting to that. So with that in case, there is going to be some deal. I truly believe that. And I think if they think this through, because if we look at this through those eyes, of what George Soros and others have been recommending for several years, and not wrong, but they've just dragged their feet for so long, and it's what they should have done to begin with. They could create a European, almost like what Obama did with those infrastructure bonds, or what was that? Make America, those bonds when he first came in and they needed to spend
Build America bonds.
Build America. So you could do a Build Europe. And I'm not saying that it's fiscally responsible in any way. It's not, but that's not what they're going to be worried about. And you could put together a package. Let's say it's 500 billion euros to build infrastructure projects all over Europe and use the capital key for those ratios and get this done. And if you did it with a European-wide bond, you would actually start doing what people have suggested, as long as you're going to, see this project all the way through to its conclusion. So you're going to need a European bond. So you could do this and get the Italians. I from everything that I read, the Italians would buy into something like that, because that's what they're really pushing for anyway. So if they did it across a European-wide situation, I think that's doable. I don't know if they have the political strength to do it. Again, I think Merkel has really dragged her feet here. Macron would pursue this in a positive, he's been dreaming about this. So I think you could see it and they could sell it in the short term. Well, that way it eases the pressure on the Italians. Everybody gets a little something, just like you in the United States, everybody's got to get something. And that's where I see it. And it would probably buoy equity markets. Any sense of discussion of this would buoy equity markets that are looking for anything, in the short term to give them some support. So I think we're going to see something out of this group. Because it's bad. The elections 2 weeks ago, a week and a half ago in Germany, the results were terrible. There was an election this week in Hesse. So everybody will be watching for this. And they're losing the middle ground so badly. I mean, the worst part about the German elections a week and a half ago was that the Social Democrats, who have always been a mainstream, middle-of-the-road policy, were down. They polled below the alternative for Germany, the AfD. So there's real problems going on. They need something, and I think that's what you're going to wind up getting out of this, because it's a way to placate a lot of people in the short term. I agree. Peter's right. I mean, who's going to buy these bonds? Let's be serious. It's a terrible, flawed policy that is now coming home to roost. We're not quite there yet, because we still got $15 billion to be bought of fresh money every month. So they're still working it. But Peter's 100% right. It will come to no good. I just don't know what the timeline is.
And what about the effect of any political movements in Europe? How could that affect all of this, like the recent elections in Bavaria, trends towards populism and the movement away from the Merkel government power?
I'll leave that to you, Ira.
Well, you know what? The populism, they're trying to make this into a global phenomenon. I don't get there. I think there are a lot of people who feel they've been disenfranchised, by what I'll refer to as the Davos elite, people who sat there and made policy, or projected a sense of making policy with little regard for a lot of people, for basically the middle classes of the world. Because let's face it, the globalization has benefited capital far more than labor, to put it in Marxist terms. And I thought the interview that Alan Greenspan had in Barron's this weekend was interesting, because he actually gave Marx high grades for certain things. I thought from him that was interesting, because I think that's right. And that's what the world has had to answer to, is the shift and the reward for global capital versus labor. And it's what we've dealt with, which is why I believe that it's a major flaw in the modeling of the Phillips curve. But that's a different discussion for another time. So I think these are real, and you have to find some way to placate those voters who really have been, wages just have not kept up, and that's by design. The whole Hartz IV in Germany was to free wages to sustain jobs in Germany rather than moving them to Eastern Europe. NAFTA, when you go back and look at the beginning of NAFTA, it was meant for the North American region to take advantage of the Canadian natural resource base, combined with U.S. capital, combined with Mexican wage rates. I mean, that simplifies it, but that's a big part of it. So wages have been the drag here, and which is why we've seen stock markets get to levels that are, we could argue, historically where they're at, but they've been rewarded versus labor. It's now starting to change, and it's going to take an adjustment. How everybody adjusts to it, I don't know. I don't know. There's movement afoot, but we shall see. But I think that to diminish it and to pretend that it doesn't exist is a major mistake, which is why we got Donald Trump.
You've recently observed, Ira, a quote by last Vice Chairman of the Fed, Stanley Fischer, who said, "We, the central bankers, cut interest rates severely to encourage growth and to support equity prices. That adjustment hasn't been fully made yet." And then you point out a dilemma, that Nehru versus Nehru. Can you elaborate?
Well, again, we're coming back to that wage thing. And they all admit, and Peter's covered this, and Jim Bianco, they all admit that they don't understand why there is no wage inflation. And I'm not saying that that's the answer, but the Nehru model, I think, is flawed. I believe it's flawed for many years, and that when you have the mobility of capital and not the mobility of labor, you wind up with a lot of pressure, downward pressure on wages. The wages just when you're given the alternative, do I want my job or do I want a wage increase? Well, Peter's younger than I am. Richard, I'm not sure how old you are, but in the 60s and 70s, when I was a teenager and starting to really get into the work world, unions had a lot of power because we were still in the post-World War II situation. Capital wasn't that mobile yet. It was just we get the breakdown of Bretton Woods. But when capital becomes so mobile and it can go in search of lower wages, and you have the transportation mechanisms, ships and containers, we can move product today. So you have the ability, and therefore labor comes up on the short end, and that's what we've seen. And so it's not a surprise. And then you're going to have another billion Indians coming into the global labor market, just like you had over a billion Chinese. Of course, those aren't exact numbers. Enter the global labor force. You had Eastern Europe unleashed into the global labor force. These have all acted to push or to keep wages flat, even as profits grew. So we built up this whole QE mechanism, searching to push inflation higher. But if it's a phenomenon that has a lot to do, number one, with global capacity, which is vast. The Chinese have vast amounts of capacity. There's the labor force, and it keeps prices down. But they built QE to push us up. But if it's not happening because their models are flawed, we're in a serious dilemma here. And how we resolve it is going to be the big question.
And your thoughts, Peter?
Well, just to quantify, a couple of years ago, the wage or the labor portion of the profit pie, that percent was the lowest since World War II. And that is now shifted, and labor is gaining more leverage. And I do expect, and I do think that the wage data has been understated, especially over the last 6 months, because most of the entrants into the labor force are young people and those with just with just a high school degree. So when you measure like average hourly earnings, for example, if that's most of the entrants, well, that lowers then the average. So I think for those that are already working, I think wage pressures are pretty persistent, and I think that's being seen in many different places, because if companies are in search of labor and they can't find it, well, they just have only a few choices in order to get it, and raising wages is obviously a key way of doing it. In today's Richmond Fed survey, and not really saying anything we don't already know, but highlighting again, they said, quote, firms were unable to find workers with skills they needed as the skills index dropped to an all-time low. Now, that's also a problem as well, is that there may be some workers out there, but there's a mismatch between what's demanded in the labor force and what is supplied. I mean, we know on the demand side, there's a record amount of job openings, but the inability to fill that is a problem. And for those that can fill it, at least now has leverage and are going to need to be paid a higher wage. And then you throw in Amazon, of course, which is raising their minimum wage, which then forces and puts pressure on a lot of other companies to respond in kind. And it sort of raises the lower end of the wage band. So how that filters into consumer prices is obviously the main question. If productivity picks up, then it would not be a big deal. But if companies find the need to pass it on into higher prices, then you got that wage price spiral that was similar to the 1970s. Not that that's necessarily going to repeat it this time around, but it gets to a broader picture here. When you look at, and it combines with my comments on interest rates, the two biggest drivers of profit margin expansion in this recovery was lower interest expense, which allowed companies to dramatically reduce that with low interest rates, and low wage costs. And now both of those are turning upwards. So can revenue growth be quick enough to deal with that? Well, likely not if 40% of S&P revenues are sourced overseas, and we see what's going on overseas. So you have profit margins that, in my opinion, have peaked out and are going to regress. To what portion to the long-term mean, we don't know, because technology is so dominant the factor nowadays. But I think that profit margins have peaked out in this cycle.
And finally, what everybody is wondering about is the last few weeks, where are global equity and bond markets heading? And what events and risk factors should we be looking out for in that regard? Starting with Ira.
Well, I think Peter and I would agree on this. First, I think bond interest rates are going higher. Bond rates are going higher. I was not looking for a curve inversion. I was interested in watching to see where they were going to hold here. So this recent, and it's interesting, the 530 as we talk is breaking out above its 200-day moving average for those who are technically oriented for the first time since I think in 2 years. It's been 2 years. So I find that interesting. You had Greenspan again in his interview. And Barron's, not that I hang on Greenspan, most things I don't. But of course, he raises the issue of entitlements and the pressure puts on, he thinks both productivity and bond values. I mean, Europe is an abomination, those bond values. We know, and part of I'll go back to that. Some of the populist fever, especially in the northern sphere of Europe, people forget that this populism is taking place in a very healthy environment. Yes, it's starting to slow a little bit, but when you measure this stuff by historical perspective, this is not when you get populism. You don't get populism when the unemployment rates are as low as they are. This is supposed to be the feel-good era, but yet something is broken. This mechanism is broken. And it's broken economically and politically, and you can't divorce one from the other. You certainly can't divorce the politics from the economics. So you are seeing this take place. It'll be healthy if bond rates would actually go up, because I believe that interest rates are a very important signaling mechanism for the entire global financial system. and it's been broken for so long. It's trying to reassert itself. Peter is the one who really, he was the first one to coin the phrase quantitative tightening. Its impact, well, we don't know what the impact was, but I think we're starting to see it. And it's amazing to me, even in the Fed minutes, they don't pay it enough heed to the fact that they're raising rates while the balance sheet is beginning to shrink. That's a dual-edged sword. And then, of course, you're having the Europeans cut back dramatically. And yet, you are dealing with lax fiscal conditions, especially in the United States. You have the deficit growing, regardless of what Larry Kudlow has to say. And these are elements taking place. So I'm looking for bond prices, especially, to begin moving higher. And we'll get a good picture in Europe after January 1st, because then the ECB will only be replenishing rather than increasing the balance sheet. So while there will be no quantitative tightening, there won't be the active participation by the ECB. And the Japanese, we don't know what they're doing. It's too hard to tell. They own so much of the market, so we're trying to get a sense of it. And the Chinese, the book is still out, but everybody who's talking about the Chinese, I think what they fail to understand is that China borrowed a lot going forward when they began a lot of stimulus in 2015 and 2016. So I think the stock market in China is more a story about, hey, they borrowed a lot from the future. The future is here. They've got some issues about how to deal with what they borrowed from the future. So it doesn't surprise me that the Chinese capital markets are as weak as they are.
And finally, your thoughts, Peter, on the trends for equity and bond markets?
I definitely agree with Ira on interest rates, and it's a variety of reasons why rates are rising, and I expect them to continue. And it's very easy for people to take out their historical playbook and say, okay, inflation and growth, those are the two drivers, and wherever that plays out, that's where rates will go. But unfortunately, we have to throw in the normalization and the reversal of these central bank balance sheets on top of Fed rate hikes. We have to deal with the foreign appetite for U.S. Treasuries, which has been dramatically reduced, partly due to the cost of hedging, but certainly also related to the dramatic reduction in reserve buildups that we've seen in China. And then you can throw in some other reasons that I think combine for a rise in rates, which will continue. And I think the big question going into 2019 is how do, and as I mentioned earlier, European bond yields respond to the ECB not adding more to their balance sheet. And I've probably said this on your show before, but just to quantify the extent at which the ECB was buying European bonds, at the peak when they were printing 80 billion euros a month, they were buying 7 times net issuance, 7 times, an extraordinary ratio, where the Fed was never buying really north of 25% of net issuance. Well, that all changes as of January 1st. Granted, they'll be reinvesting, but on a net basis, they will not be expanding their balance sheets. And again, who's going to buy this stuff? So if you get a rise in German bund yields, you have to believe that you're going to see a coincident rise in U.S. Treasuries. With respect to U.S. stocks, it's been a party for 10 years, and what typically ends the party is Fed tightening. And I think it'd be hard to think that this is not going to happen again. Valuations are very expensive in the U.S. If you look at metrics other than just a PE multiple on 1 year's earnings, if you look at a variety of others, particularly price to sales ratio, and we're very expensive. Also, the rise in rates is having an economic impact, which has the potential of hurting earnings. So I'm pretty defensive when it comes to U.S. equities. I am becoming more intrigued with the value being created in overseas markets that have gotten hammered. You look at China, for example, and China's going to have a couple of years of serious challenges, no question. But the market's gotten pretty cheap, and it's down almost 60% from its highs in 2007. And even Japan, the Nikkei is down almost 50% where it was from 1989. Now, I know that's been the case for a long time now, but you're looking for value. It's unlikely you're going to find much in the U.S. but you have the potential of finding a lot of it overseas.
Mm-hmm.
And then lastly, I remain bullish of gold and silver because I think that's a respite in this crazy environment. And the dollar has been strong against some emerging market currencies, particularly the yuan, and the troubled ones like the lira and the Argentinian peso, and certainly the British pound related to Brexit. But the dollar index over the past 2 years has done nothing. It's gone up, it's gone down, and it's pretty much at the same level it's been. So I think that points to major headwinds for the dollar, and maybe it's the twin deficits that people are now beginning to focus on.
Well, great insight as always, gentlemen. How can our listeners learn more about?
Wait, Richard,
Okay.
Can we come back to one thing?
Oh yeah, sure.
Especially in regards to China. Unfortunately, the airwaves get filled with ludicrous assessments. I mean, it's really ludicrous. I had to listen to somebody's tirade yesterday that what the United States, what Trump and Navarro especially were trying to do was force regime change in China. Well, that's such a ridiculous concept. If that was the case, then you'd be on the verge of not a cold war, of a hot war. Because if you think that the Chinese would cave to U.S. pressure for regime change, it was for 10 minutes I had to listen to it, and I'm going, it's ludicrous. People need to be, and this is just a warning, be careful about what you hear and what you listen to. There are a lot of people out there with ridiculous narratives. And that one was mind-boggling because that is not happening. That shows no understanding of how China works, of the politics of China. China, we want to think in terms of a Western-style democratic capitalist model. It's just not appropriate. You may wish that for the end result in China, and they may get there. But the present situation is so far from that any discussion of what the Trump administration is really pushing for and what they think that they're able to get, because why would you pursue a ridiculous policy if you had no chance of ever attaining it? So I just, it's to the listeners to be cautious about what they allow to filter. They need a filter. That's what I'm advising against. You need a filter, and you have to understand what the entire global perspective is, rather than somebody who may just be selling something. So be very careful.
Great, and we'll end it on those words of wisdom. Thank you very much, gentlemen. How can our listeners learn more about your work, Ira?
I'm still I blog at Notes from Underground. It's a pleasure, and of course doing podcasts like these, and it makes for important discussion. And this, again, I advise people, you need to read. You need to subscribe to people like Peter work, because you can't do this alone. This is an endeavor. To be a trader or investor takes a lot of effort. And it takes a lot of discourse between people. I mean, when I was a floor trader, that was one of the great things about being on the floor, is you had opportunities to discuss things with people. Now that we get more isolated and atomized by computers, we lose that ability. So anytime that you can involve yourself in any of these discussions, and to read as much as possible of the quality work that's out there, and believe me, Peter's work is quality, avail yourself of the opportunity, because that will suit you, and listening to these podcasts.
Yes, exactly. And Peter?
Thank you, Ira, for that. So you can read my daily work by subscribing to bookreport.com. And as Rich mentioned earlier, BOOCKreport.com. And if you're interested in assistance with wealth management, you can reach out to me at bleakley.com.
Great. Thank you very much, gentlemen. We'll do it again.
The FRA Roundtable Insight Show is for informational and educational purposes only. and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.